Everyone, me Kevin here. The Federal Reserve minutes just came out and the stock market isn't quite sure what to do with it, but I've got some insights for you in terms of what was said and, importantly folks, what was not said. And some of it, quite frankly, is frustrating. First of all, no mention, not a single mention of the word recession. Don't worry, the stock market might be pricing in a 70 to 90% chance of recession. More than 70% of adults in the United States might be expecting a recession in 2022, but don't worry, it has not risen to the level of the Fed actually getting out of their White Castle and going, oh damn, we actually might be in a recession. Yeah, nope, no mention of the word recession. Fortunately though, there was also no mention of the word transitory, and unfortunately there was no mention of the word pause, in other words, pausing rate hikes. There were 6 mentions of tighter financial conditions and 90 mentions of inflation, which is pretty wild. But there was something that kind of pissed me off right at the beginning of the notes, and we're going to talk about those because I'm going to pull them up and I'm going to show you the notes right now, right after I mention that, folks. We got to get into the notes. That's it. What were you expecting? I just wanted to get right into the notes, okay? I don't know what you were expecting. After the release of higher than expected inflation data, okay? This is the section I gotta tell you. But remember what Jay Powell told us during the last meeting. He told us that we are expecting 75 basis point moves to be rare. To our face. He told America 75 basis point moves like this, they're gonna be rare. They're gonna be rare. But at the same time, even though Jay Powell is saying they're going to be rare, in the minutes of the meeting, so in other words, in the meeting, they said that there was a considerable probability of 75 basis point moves at both the June and July meeting. Considerable probability of 75 basis point hikes, which is what the bond market's pricing in anyway, so it's not that big of a deal. But still, there's a difference between considerable probability of 75 basis points in June and July and, hey guys, we're raising rates 75 basis points, but don't worry, this is going to be rare. Dude, this is literally like transitory all over again, except now we're using rare. Like, what is it with the English language and wanting to try to confuse us? I don't know. It really bothers me. But you know what doesn't bother me is that we go through fundamental analysis now every single day in our course member live streams. And if you're not part of them yet, you may as well join. So that way you can learn how we do fundamental analysis, how we do math to get projections set, how we do initial and deep dive fundamental analyses every single day in our course member live stream. So if you want to learn more about stocks, make sure you use that 50% off coupon code link down below. Join the programs. The prices do go up over the time. You can use the Wayback Machine and see, oh damn, Kevin's not just saying that. The price actually does go up hundreds of dollars over time, and we're releasing a huge batch of lectures at the end of this week. Let's keep going through the notes here. Continued expectations that inflation would decline notably. That is, market-based expectations of inflation are that inflation was going to continue to decline notably. Now, they're not terribly wrong about this. The break-even rates right now for treasuries are pretty low. In fact, take a look at this. I'm gonna drag them up right here. This is today, the 5-year and the 10-year break-even rate for inflation. Going back, you can see at the bottom here, we've got May here, we've got June over here, and here we sit right here. We have taken these inflation break-evens and basically gone straight down on both the 10-year and the 5-year. I hate to say it, but for the people thinking that inflation is the big deal here, it doesn't appear to be, at least not according to the bond market. What appears to be more so the big deal, folks, is the potential that we're going to walk right into a recession. And but you know, the Fed doesn't even want to mention the R word. All right, let's go ahead and take a look at some of the other notes that we have here. So we've got a section. I'm just going to really show you the important ones. Inflation was expected to remain high in the short term, but fall back to 2%, consistent with their 2% target in the longer run. I really doubt this anytime soon, especially since we're going to have a lot of residual wins coming in from owner's equivalent rents. As mortgage rates go up, more people tend to go to rent, and that could squeeze rents up in some areas, though rents have started coming down in some super hot areas as less people are potentially moving. In general. Now, okay, we've got a little bit of weakness in retail sales in May, home sales starting to move down a little bit. These are all expected. GDP growth appeared to be rebounding after a decline in the first quarter. Now, I find this really interesting because if you look at the Federal Reserve Bank of Atlanta and their GDP Now forecast, you actually get a very, very different story. In their GDP Now forecast, they're suggesting that we are basically in a recession right now, which is, I think, what a lot of us feel. A lot of us as Americans, a lot of us as just investors or people, we are feeling the following, folks. This right here, this is the Federal Reserve Bank of Atlanta's estimate, and the 0% GDP line is right there. And the Fed thinks GDP is actually doing this, down to somewhere around that 2.1 negative percent territory. So a little in contrast there with the Fed. Credit remained widely available, especially for those with higher credit scores. This was interesting. Credit card balances at commercial banks rose in April at the fastest pace seen in recent decades. This, by the way, I wanted to show this chart. This is a chart of inflation mentions. We are now at the highest level of inflation mentions at any of the Fed minutes. The level of real GDP was still expected to remain well above potential. I don't know if they're just smoking something funny or if they're lying to us. I still haven't quite figured it out, but I take it with a grain of salt because we're definitely seeing spending growth decline, and that's why we're expecting earnings growth to decline at companies. Now, this was interesting. They saw an appropriate firming of monetary policy and associated tightening in financial conditions as playing a central role in helping address this imbalance and supporting the Federal Reserve's goals. Well, the problem with tighter financial conditions is really the market over the last month here has actually been pricing in looser financial conditions, not tighter. Take a look at this. This is the 10-year Treasury yield. And what do we see? It's gone from 3.5%, which is a tight financial condition, to 2.9%. I mean, that's a massive plummet in the 10-year Treasury yield. So kind of weird that, we have this in June. This meeting happened here. So in other words, let's align this, okay? This meeting happened in June. And they're like, yes, the market is doing our work for us. This is wonderful. The market is on the same page with us, and they're helping us. See, they said, in helping address this imbalance. They used the word helping. Well, apparently, the market's like, yeah, no, F you, Fed. We ain't helping you do your job anymore because you're pushing us into recession. We're done helping you. The problem with this is this declining chart right here, the 10-year Treasury yield, and looser monetary or looser financial conditions, is that potentially going to motivate the Fed to take out the ladle and bend us over onto the table and start smacking us. It's quite possible. Now, especially since, take a look at this. We had expectations that the JOLTS numbers this morning would come in at 11 million, but instead we beat expectations. We had 11.254 million job openings. That is more than expected. It is a beat. And so clearly the labor market is continuing to remain tight, which kind of starts creating problems because the Fed wants to see those job openings come down. And they didn't, at least in the last measure. So again, more room for some spankage. Anyway, this is what the Federal Reserve said. Check out the coupon code down below. Take advantage of it before the price goes up yet again. And I know people are like, oh, Kevin, why do you always raise the price? You're contributing to inflation. Because there's so much demand, baby. Let's go.